Hello and welcome to Cash Basis Accounting Fundamentals and Terms. My name is Vivian Vandenberg from the Local Government Support Team here at the State Auditor's Office. This training is going to stick to intro level information, so if you're not very familiar with accounting, this training is for you. If you are familiar with accounting, this will mostly be a refresher. We're going to start with accounting vocabulary, which will include defining some of the most common terms used in accounting. Then we'll go over the basics of revenues and expenditures. After we learn about that, we'll discuss some common transactions in cash basis accounting. We will conclude by discussing the reporting of cash balances for cash basis accounting governments. Let's get started. We're going to get started by looking at various accounting terms so that you can become familiar with the various terms that we'll be using throughout this training. First up is defining the basis of accounting. There are several different ways that accounting can be done. We'll cover 3 of those. The first is accrual accounting. This is what you would have learned in your general accounting classes in college. You record revenue when it's earned and expenses when they're incurred, regardless of when the cash is exchanged. Then we have governmental accounting. In Washington State, there are 2 bases of accounting that local governments can choose from. One is GAAP, which means Generally Accepted Accounting Principles. This is accrual accounting with some additional special rules, and we have a separate training on governmental GAAP accounting. The second is cash basis, which is basically what it sounds like. Transactions are recorded when the cash is received or dispersed with some special rules. This is going to be the focus of our training. We will spend some time covering the basics of cash basis accounting and those special rules. Sometimes people use the term bookkeeping and accounting interchangeably, but they really do mean different things. Bookkeeping is the act of gathering and recording daily transactions, so that's like collecting the invoices and entering that information into the accounting system. Financial accounting goes even further, so it's not only recording the transactions, but it also includes summarizing and reporting. That would be like preparing monthly or annual financial statements. It also includes analyzing and interpreting the financial data, so looking at revenue or expense trends and determining why something's changed over time. Financial accounting is also really important because it offers accountability and transparency by reporting the financial information in a way that can be read and reviewed by others outside of the accounting department. For example, a governing board, investors, or citizens can look at the financials and understand the current status of the organization. Next, we have account. Within the accounting world, this means a way to categorize and track financial activities. Some account types that you might be familiar with include assets, liabilities, expenses, revenues, and so on. A ledger is the book or software that contains the different accounts. This used to be a physical book where accountants would record each account and transactions within the accounts. Most governments are now using software to track all their financial activity, though. You may hear this referred to as their general ledger, or GL. Some governments may even have sub-ledgers for specific activity. Transactions get entered into the ledgers via journal entry, sometimes also called journal voucher. The journal entry is just the transaction information translated to a specific accounting format. We'll practice that later. We use what we call double entry accounting, which means every single journal entry impacts at least 2 different accounts. The journal entry has equal and opposite effects on those 2 accounts, which are recorded as debits and credits. Said another way, the journal entry debits must equal the credits. When viewing a journal entry, which we'll look at a few examples here in a moment, the debit is the left side of the journal entry, and the credit is the right side. Debits will increase cash and expense accounts. However, it has the opposite effect on other accounts and decreases revenue accounts. Credits are the exact exact opposite. Credits increase revenues. However, credits will decrease cash and expense accounts. Let's switch gears and talk about some of the accounts that governments maintain. Starting out with assets. Assets are resources with two characteristics. One, they have present service capacity, and two, the government controls it. Present service capacity means that the asset can be used to provide services or enable the government to fulfill its mission. And control means the government can utilize the asset and determine the nature and manner of use. Now, cash is a significant asset because it has both characteristics. It provides present service capacity because they can spend it to provide public services, and the government controls it. They get to decide its nature and manner of use. So as example, they can choose to invest it or they can spend it fixing the roads. Cash can also be held in various ways by a government. A government can hold their cash in bank accounts, special investment accounts, or at the government itself in funds called petty cash or change drawers. Cash also can be held by a government's fiscal agent, and we'll cover those relationships in this training. I mentioned investment accounts are available to governments, including the Local Government Investment Pool, also known as LGIP. Revenues at a government are inflows of resources that are unable to be classified as other increases. Other increases are specifically defined in the Cash Basis BARS manual. Activities recorded as revenues range from tax revenues to charges for goods and services, and grants and other intergovernmental receipts. Other increases are inflows as a result from situations like issuing debt, the transfer of funds between the government, the sale of capital assets, and other like transactions. Again, these inflows are defined in the BARS manual if there are other inflows that a government is receiving not listed here. On the other side, there are expenditures, which are the various uses of a government's cash, therefore an outflow of resources. Similar to other increases, there are specific activities defined as other decreases by the BARS manual. Expenditures are activities such as salaries and wages, benefits, supply purchases, and service expenditures. Other decreases consist of other uses, items such as debt payments, the purchase of capital assets, and transfers out of other funds of the government. Now that we've discussed the different account types of cash basis accounting, the normal balance for those accounts are as follows. Cash and investment accounts and expenditure and other decrease accounts normally have a debit balance, while revenues and other increases, their normal balance is a credit. Knowing these normal balances greatly assists in identifying the journal entries necessary to record various accounting transactions in the daily activities at a government. As we close out our terms discussion, we're going to dive a little further into cash basis accounting and how specific accounts are used. Let's start discussing when a cash basis government should record what activity. In the simplest way, you should record the activity when the cash flow occurs. To be specific, revenue should be recorded when cash is received in the government's accounts, this being the government's own accounts or accounts held with their fiscal agents. Expenditures should be recorded when cash is paid or when a check or warrant is issued. Note that this does not consider the clearing of the funds from the bank. If the government has written a check or issued the warrant, that is the triggering moment for recording the activity. Please take a moment to pause this video and visit the Cash BARS manual. Once in the manual, visit the accounting part. Expand the chapter for accounting principles and internal control, and go to the section titled Accounting Principles. Focus your attention on paragraph 30, titled Revenue, Expenditure, and Transfer Classifications. Read this paragraph for an additional understanding and details regarding revenues and expenditures. Now we can start talking using the journal entry system we discussed earlier. Let's start with a revenue example. Our example is this. The government provides water and sewer services to its citizens. On December 5th, they send the water and sewer bills to their citizens for water used in November. At this point, we have no journal entry under cash basis accounting because no revenue has been receipted. Our example then moves to January when we receive a payment from a customer. Now we've receipted cash, so we have a revenue. So now we translate this information into a journal entry format. We receipted the cash. Cash has a normal debit balance, so to increase it, we need a debit. We also want to increase our revenue, which has a normal credit balance, so to increase the revenue, we need a credit. Often, there are services that a government provides in which they utilize a third party to assist in that activity. To provide visual, let's discuss a government that provides water and sewer service to its citizens. In this case, the government has contracted with a third party to assist in the billing and collection of the payments for water and sewer services. The third party is collecting the revenue associated with the bills to citizens. However, the government still must record this revenue as their own, since this third party is still in fact acting on the behalf of the government as a fiscal agent. To further discuss this third party and provide more context, here's an example. A government utilizing a third party receives a statement and the related revenue they were holding on January 5th, 2024. In reviewing the statement, the government learns that the cash received from the third party supports revenues that are from December 1st through 31st of 2023. As the government notes from the statement, the revenues received from the third party should be recorded in their general ledger as revenues for fiscal year 2023. Now let's look at the recording of an expenditure. The government receives an invoice for their phone bill on December 20th for coverage in November. At this time, there's no cash leaving the government, and therefore the government doesn't have an entry to enter. Now moving forward, the government writes a check on January 15th. At this time, the government is recording the entry into the general ledger. You'll see that the bill was for $400, and so there's a debit and credit recorded against each, the expenditure and the cash being used to pay the bill. As we know, checks don't automatically withdraw the funds from an account, so we note that the check is cleared on February 1st. For this activity, there is no journal entry. Now, Washington state law allows for what's called an open period. An open period is a period that occurs after fiscal year end in cash basis accounting where expenditures can be charged against the previous period for claims incurred in the previous period. An example of this is if a construction company bills the government for work performed in December in January of the following year. The payment to that construction company can be recorded in December rather than in January when the government is paying for the activity. An open period is required by state law for city and county governments. City governments can be governed by either RCW 3533 or 35A33, depending on their class, and county governments are governed by RCW 3640-200. The rules are slightly different for special purpose districts. In the case that a special purpose district utilizes a city or a county as their treasurer, they have the option to use the same open period as that treasurer. If a special purpose district does not use a treasurer that has an RCW in state law, there is no open period available to them. Often there is confusion that everything in the first 20 days of the year should be reported in the prior year, since the city has a 20-day open period allowed. However, that's not entirely true. Only things that were budgeted for in the prior year qualify for open period treatment. Let's discuss a few transactions that may occur during this time frame and what fiscal year each of those should be recorded in. The first transaction is an order of supplies for $500 that was ordered in December and budgeted in December. The second transaction is another supplies order, this one for $300, and was made in January and budgeted for January. And finally, we have a check issued for $3,000 to cover December payroll. Note that the first transaction and the third transactions are for December activity and therefore are expenditures of December. That supplies purchase of $300, it did occur in the 20-day open period, but it was an order in January and therefore is reported as an expenditure of January. Pause the video again to return to the cash basis bars manual. Once you're in the manual, continue within the accounting part. Expand the chapter Accounting Principle and Internal Control and return to the Accounting Principles section. This time, focus your attention on paragraph 40 titled Basis of Accounting, which discusses the open period. Now that we know the major account types, we will dive in a little further into the accounting and how specific accounts are used. First, let's discuss a common transaction that occurs due to how many governments utilize their accounts. This visual is based on a government utilizing the county as their treasurer. However, this can be used by any government that utilizes more than one account. The transfer of cash between accounts is not a revenue or an expenditure. This is because no asset actually left the government. It only left one account to live in another. See the journal entry presented here, a debit to cash and a credit to cash. Let's look at another cash transfer transaction. The county collects the tax revenue for a local government, and that local government utilizes a separate bank account for paying bills. This government must transfer the tax revenue from their account at the county to their bank account in order to have available funds for the bills. So, this transaction requires a few entries. The initial entry is a debit to cash and a credit to property tax revenue. This transaction will, in essence, increase the cash balance for the government and increase the property tax revenue. As we discussed earlier, a credit to a revenue is increasing the revenue. This initial entry is only to recognize the receipt of the property tax revenue collected. Now moving into the next part of the transaction, the transfer of the cash from the county held account into their bank account. Note that each side of this transaction is for cash. The debit is the increase in the cash balance in the local government's own account, whereas the credit is the decrease in the cash balance held with the county. To finish out the entire transaction, we need to determine the journal entry for the recording of the payment of the government's bills. In this case, cash is going to finally be leaving the government's accounts, and in this case, we will need to credit the cash balance of the government to represent the distribution of funds in order to pay these bills. The debit part of this transaction is to expenditures, Again, recall in this session that we are required to debit expenditures in order to increase that balance. Petty cash is a common activity that governments perform. Let's look at transactions surrounding a petty cash fund. First, a government must establish a petty cash fund. In order to do so, a government has a debit to one cash account and a credit to another cash account. In this case, there's no revenue or expenditure occurring for the government as there's no cash that has actually left the accounts of the government. Next comes the use of the account. The government in this case utilizes the petty cash account to purchase stamps for use at the government. In this part of the transaction, there's nothing for the government to record yet. Which leads us to the end of the transaction. The government is required to replenish the petty cash account in order for that account to return to its approved balance of $1,000. Based on the journal entry here, we can see that the government must record the expenditure of $85 in order to increase that balance. I previously stated that the journal entry was being recorded to return the petty cash account to its approved balance. This is because of some of the special rules that are in place regarding petty cash accounts. Petty cash accounts should be reconciled and replenished on a monthly basis. A government having strong internal controls are essential when a petty cash account is used, and reconciling that account monthly is a great way to evidence strong internal controls. Along with that, a year-end reconciliation and replenishment should always be performed. Not only is this because of the initial rule discussed, but this ensures that all of the expenditure activity that the government has had is recorded in the appropriate period. Petty cash accounts still hold cash that belongs to a government, and because of this, a petty cash account balance at year-end should be included and reported in the government's cash balance. Oftentimes, this is an oversight at governments. However, this is critical to ensure transparent reporting to external parties of the government's held assets, which in this case are the cash balances available for use. The BARS manual published for our office includes additional rules and information for petty cash accounts. It's included in our accounting section under expenditures in section 3.8.8. Go ahead and pause this video again. We're going to go back out to the Cash Basis BARS manual. This time, we're going to spend some time with the expenditure section. If you visit the page Impressed Petty Cash and Other Revolving Funds, review and read this section to familiarize yourself with rules and additional internal controls regarding these funds. Sometimes governments will utilize clearing accounts. Clearing accounts can be one type or both, which is often different from one government to another. Let's talk about both types. Some governments may have a clearing general ledger fund. This is used by a government that transfers outstanding warrants and disbursements from the funds that are paying the invoices to a separate fund that will disperse the funds from the government. On the other hand, some governments utilize a clearing bank account. This bank account is where the cash for the outstanding warrants and disbursements will live until the payments are received by the payee. Governments can choose to utilize these funds or accounts. However, they're not required to. They can also use both if they elect. While there are different types of clearing account options, both options do have similar rules and intent. Both are considered an internal accounting tool for the tracking of outstanding warrants and checks for a government. Transfers should occur the same day the warrants and checks are issued. If your government is using a bank account clearing account, that means transferring the cash from your main checking account to the clearing account. And if a general ledger account is being used, that means transferring the cash from the normal funds to the clearing fund. So the cash should be transferred from the fund that experienced the expenditure. Now you can see the same intent, just slightly different application depending on which method is used. These funds also function under the expectation that the clearing funds will have $0 balances after all checks and warrants are cleared. When a government is reconciling, if there is still remaining an outstanding balance in these accounts, they should be evaluated and it should be determined why there's a reconciling item for these funds and what exactly it is. There's a page dedicated to these account types in our accounting manual located in section 3.8.6 in case you're looking for more details. Let's pull a full example together to detail the flow of the transactions in clearing accounts. Now, step 1. The government has calculated their payroll for March on April 10th. They have determined that the payroll expenditure is $60,000. Step 2. They need to record a payroll expenditure and a cash reduction in the funds of the government responsible for the payroll. Step 3. The government then transfers the $60,000 from their bank account to their clearing bank account, again located at the bank, in which the payroll checks will be redeemed from. Remember, since this is just moving cash from one bank account to another, there is no revenue or expenditure reported. At the same time, the government also enters a transaction in the clearing account general ledger on the same date as that cash transfer. Again, this is just transferring cash from one fund to another, so no revenue or expenditure will be reported during this step. Not pictured here is the clearing of the $60,000 in salaries and wages. On the same day, the checks and salaries, wages, and benefits will clear from the bank account and the general ledger account. Theoretically, the bank account and general ledger account are reconciled to $0 on the date of April 10th. Okay, let's move into investments. When discussing BARS codes, it's important to know that there's no specific code for the portion of a government's balance that is going to identify the investments separate from the cash. The balances are reported to the same set of BARS codes, but based on the classification that best reflects any limitations on how the balances can be used. With that, it's important to note that the purchase of an investment is truly the movement of cash between different accounts rather than an expenditure of the government. So here is a journal entry to visually explain that transaction. First, the purchase of the investment. This journal entry is going to debit the investment ledger and credit the cash ledger. The same thought process is true for selling an investment. This transaction will not result in a revenue for the government. We're just moving money from one fund to another. You will see here, we're going to debit cash and credit the investment for the sale. Please take a moment to pause this video and visit the Cash BARS manual. Once in the manual, visit the accounting part, expand the chapter for accounting principle and internal control, and go to the section titled Beginning and Ending Cash and Investment Classifications. Please read through sections 3.1.8.10 through 3.1.8.31. These sections will allow you to familiarize yourself and the available cash and investment classifications for cash basis governments. Another common activity is the use of a fiscal agent in governments. A fiscal agent is another party that handles and processes the government's funds on their behalf. Think about a bank or an escrow agent. The bank may issue loan funds directly to a vendor for the purchase of a vehicle, such as a snowplow. In this case, the bank has approved the bank loan for the city and is paying the vendor directly with those funds for the purchase of the city's new snowplow. Additionally, a government may be using an escrow agent to assist in refunding a bond. In this case, that escrow agent will receive the bond proceeds and then pay off that old bond on behalf of the government. With those two quick examples, let's look a little closer at these transactions. We'll start off with a bank assisting a city with the purchase of land. The bank, acting as the city's fiscal agent, is issuing a loan to the city for the purchase of this land. Because the bank is acting on behalf of the government, the funds will be sent directly to the seller of the land. The city will never see the funds pass through their accounts. However, this is still a transaction of the city due to the fiscal agent relationship between the two parties. The city does still record the transaction in their own accounting system. The land will be owned by the city, and therefore the city should record an entry to recognize the capital expenditure for the land purchase and the debt proceeds that were issued by the bank in the city's name. Let's talk about a fiscal agent relationship using an escrow. So let's say the government is still buying that new piece of land. As a part of the purchase process, the government is required to deposit $10,000 of earnest money with a fiscal agent. The government is essentially just moving their money from their own bank account into a special bank account held by the fiscal agent. At this point, it is still the government's cash, so no expenditure is reported. If or when the sale goes through, the escrow money is dispersed to the seller, and that is when the expenditure is recorded. With that, here you'll see the two entries. The first being the movement of cash, and the second is the recognition of this capital expenditure. A couple more examples of a fiscal agent are the local program and how bonds are refunded. These two situations also involve a party separate from the primary government. However, the transactions are handled by these agents on behalf of the primary government and should be recognized by the government. There are accounting sections included in the BAR's manual on these two different situations, as we have listed here. In summary, any party that is handling resources for a government is considered a fiscal agent, and all the transactions handled by that fiscal agent should be recognized by the government. Now that we've covered various transactions, let's move on to talk about what's left at year-end after all the transactions are recorded, the cash balances of the government. When determining ending cash, it's important to reconcile your accounting system to your bank statements. We often talk about reconciling, and reporting at year-end is one of the benefiting times of a consistent and regular reconciliation. Ensuring all activity is reconciled will assist in providing reassurance that all of the amounts in the bank accounts are accounted for in the accounting system. Governments should also ensure that all petty cash and change accounts are included in the ending cash balance for reporting on the Schedule O1. These accounts and their related amounts are often easily forgotten. Cash basis government's reconciliation processes include various activities, such as deposits in transit and outstanding and open period items, which are necessary considerations for reporting ending cash balances. Of those items, deposits in transit, they should be included. Deposits in transit are those that have been receipted into the government's accounting system. However, the funds have not been included in the bank accounts of the government, and therefore they don't show up on the bank statements at the time of reporting. There are some items that are excluded, which should naturally happen as part of the reconciliation process. One of the items excluded are outstanding checks and warrants. Opposite of deposits in transit, these are expenditures that have been recognized in the government's accounting system. The similarity between the two, though, is that these expenditures haven't cleared the government's bank account. With that, the bank accounts still appear to have these resources available. However, they've already been utilized. This is why these balances are excluded from the government's ending cash balances. Sometimes, cash basis governments utilize that open period for expenditures, which we discussed earlier. Note that those two are transactions that must be considered in the ending cash balance for the government. These expenditures have also been accounted for in the government's accounting system, and therefore resources must be reduced by these balances also. Let's put all of this information to an example and calculate the ending cash balance. Starting with the bank statement balance of $195,500. In addition, this government has a petty cash account that holds and is reconciled to the approved $1,000. It looks like there are several reconciling items that we must consider though. Starting out with deposits and transits of $250. This will increase the cash balance. Then there are outstanding checks and warrants totaling $500 and open period expenditures of $300. Both of these will decrease the ending cash balance of the government. All of these items considered will bring us to an ending cash balance of $195,950 to be reported by this government. Make note that this ending cash balance should tie to the ending cash balance that's recorded in the general ledger of the government. Now you may be looking for additional resources after watching this video. And if so, here are a few areas of our online accounting manual that you might find helpful. While the manual offers all sorts of guidance, the Accounting Principles page found in the Accounting section will provide some of the same information and additional details on the topics discussed in this training. Additionally, the Charts of Accounts section has several pages that are available, providing some information that can lay a great foundation for our journey in learning more about governmental accounting. In addition to reading materials, the website also offers numerous training videos. The training library is consistently monitored and updated with the additional guidance and topics. The introduction to the BARS manual video will guide a user through the manual and discuss each of the section's offerings. Also available is the Introduction to Fund Principles video, which is intended to provide additional foundational accounting information. Thank you for joining us today. We appreciate your support. If you have any follow-up questions, please feel free to contact us via the help desk. We are always happy to help.